Well, stocks plunge on Wall Street after a weak jobs report has traders questioning the Federal Reserve. Employers hiring 114,000 workers in July, far fewer than expected, and the unemployment rate climbed to 4.3% from 4.1% in June. That set off alarm bells among some economists who say the economy is showing early signs of a possible recession. The Dow fell 610 points, nearly 2%. The NASDAQ plunging 417 points, more than 2.5%. That index moved into correction territory, 10% below its recent high. The S&P down by 100 points. Let's bring in James McBride, certified financial planner from the McBride Group. Thank you for joining us this morning, this afternoon rather. I'm used to working mornings. So, first off, the news of the day here in California, the news that Chevron is moving its headquarters. What does that mean? What kind of impact does that have? And what does that say about how the energy industry looks at California? Tom was talking about that a moment ago.
Yeah, I think it has to do with how industry in general looks at California. California has a very if not anti, at least standoffish attitude towards business. I think it's a big black eye for California. And just as Crystal was saying, that this follows Tesla leaving. So, California has a very anti-business attitude, and Chevron specifically referred to overregulation in their statement of why they were leaving. So there you go.
And the broader context now about that jobs report, unemployment reaching 4.3%, not historically high, but still it definitely rattled the markets. Why is that? What's going on? Why did that give investors reason for pause?
Well, I think the gap between what people were expecting, which was 185,000, and they came in with 114, that's a pretty big gap. So that could rattle everybody. I think, too, the stock market's been pretty hot. At the end of July, the S&P was up something like 16%, and the NASDAQ was up 19%, and you've heard all the stories about artificial intelligence. So people were getting a little bit antsy, expecting a pullback. But if you look at the numbers today, the Dow was down, 600, but 2 days ago it was up 600. The NASDAQ was down 217 today. 2 days ago was up 451. So things are volatile, that's fair to say. And maybe this is one of those tipping points that people's concerns sort of go to the forefront.
Well, and to that volatility, I'm wondering if the fact that we're in an election year might have something to do with that. I know that sometimes economists and investors are concerned, especially when we're within 100 days of an election. Maybe there's some hesitancy there. Do you think that that's some of what we're seeing right now as we lead up to the general election in November?
I think we're all in the unknown. We don't know, who's going to win and how Congress is going to go, and it's the unknown that makes people uncomfortable. I can tell you what Wall Street wants, and that's a divided government. If Ms. Harris prevails in the presidency, Wall Street's going to want at least one House of Congress to be held by the Republicans, and vice versa if Mr. Trump prevails. A divided government is thought to be best from Wall Street's point of view.
Yeah, absolutely. And to that end, are we looking at a blip here in terms of what we've seen with what investors did today? That concern that they had there. Is there any way to predict if this is just a little blip or if this is something that maybe might sustain? Are we trying to see some weak parts possibly of the economy here?
Yeah, people are always concerned about weakness in the economy and the prospect for a recession. But to answer your question, I think what we need to do is we need to see 2 or 3 more reports and take an average. I've always thought it's best to look at these numbers on a quarter-over-quarter basis, even a year-over-year basis, because it's hard to pick a trend with just one report. And there's a history of these reports bouncing all around. But as far as how it affects the stock market, it's one piece of the puzzle. But the biggest piece of the puzzle for the stock market is always going to be earnings. Stock prices reflect current and future earnings expectations, pure and simple. So this is important. But as you pointed out, the unemployment rate at 4.3 is very low historically. I went back and looked. There was a report from the Bureau of Labor Statistics that showed the unemployment rate for the last 75 years, and the average was 5.69. We're nowhere close to that.
Right.
And one reason why I went to 4.1 to 4.3 is more people are coming into the workforce. That's a good thing.
Yeah. Interesting. And so we're talking about jobs, briefly wondering, because for months the talk has been interest rates, right? And what impact that's going to have. I'm wondering if that's still factoring in, or can we keep our eye on both of those, so to speak, going forward?
Well, no, that's why you don't want to be the chairman of the Federal Reserve, because the Federal Reserve has what's called a dual mandate, and one of their mandates is full employment, and the other mandate is price stability, which we think of as controlling inflation. Well, we are on target to that 2% level. The current inflation rate, as measured by the Fed's PCE index, personal consumption expenditures, is 2.69. We're pretty much there. And as you pointed out, unemployment is historically low, you know, 4.1, 4.3 right now. So there you go. You have pretty doggone good unemployment numbers, extraordinarily good inflation numbers when you look back, say, just a couple of years. So you have the Fed doing a pretty great job based on the numbers, and a lot of people, Christian, are unhappy.
Well, that's why we have you here to help us pull that apart and try to get some perspective on it. James McBride, thank you so much for lending your expertise. We appreciate it.
My pleasure.
All right.